You want to get started?
Okay.
Get started?
Great. Okay, everyone, again, thank you for joining us. My name is Michael Halkias.
And I'm Kathy Davis.
We're both partners here at MSPC, and we'll be giving you a brief presentation on opportunity zones. We're going to go over what opportunity zones are, the types of investments the opportunity zones can make, the types of tax benefits they can hope to receive, and some issues that a potential investor might want to consider. Before we get started, I just want to say that, obviously we're not giving you investment advice. You should talk to your investment advisor to go into the details of any potential investment you might make. But we are trying to give you a broad outline of the potential benefits of this tax code change, and we hope we find it useful.
Yes. So I'll just jump in with some basics and some definitions about what is an opportunity zone. So the opportunity zones were newly created with the Tax Cuts and Jobs Act of December 2017. And the purpose is to spur long-term economic development and job creation in distressed communities. So how do they come to be opportunity zones? Well, first they had to pass eligibility tests, and the eligibility tests included having a minimum of a 20% poverty rate and median family income that was no greater than 80% of the area median. After they passed a certain number of eligibility tests, then the states got to work on selecting and nominating census tracts, areas for designation as opportunity zones. They submitted those nominations to the government, and then they were certified by the Secretary of State. So after all this was said and done, there's close to 9,000 opportunity zones, and they exist in all 50 states and in Puerto Rico.
A couple quick notes on that, just for your consideration. Kathy mentioned that the opportunity zones are designated by census tracts, not by municipalities. So you might hear that a certain town has an opportunity zone. It might be certain streets or certain neighborhoods within the town, but not necessarily the entire municipality. So we then wanted to talk just a little bit about how you can invest in an opportunity zone. Unlike many other types of programs with the federal government, you're not able as an individual to invest in an opportunity zone and receive the tax benefits we're going to discuss later. There's a requirement under the tax code that you invest through a vehicle that we call a Qualified Opportunity Fund, or a QOF. Now, the Qualified Opportunity Fund can take almost any legal structure. It could be partnership, it can be an LLC, an LLP, or a corporation, but it must make a certain election with the federal government in order to avail the owners of the tax benefits that a Qualified Opportunity Fund allows. I think one other thing that we need to be very specific about is that even though the zones are designated by these census tracts, and we're talking about actual area on the ground, one of the few things that a Qualified Opportunity Fund cannot invest in is land. So you must place the investments within the zone, within the geographic boundaries of a Qualified Opportunity Zone. But the investment itself must be a physical asset that is not land. So it would include buildings and building improvements. It would include equipment and furnishings, but it would not include the underlying land itself.
Right. So to talk a little bit about what's so attractive about investing in opportunity zones, there's three main benefits to these investments. The first one is deferring gains that would otherwise be currently recognized and therefore taxable. The second is potential elimination of some of that gain, up to 15%. And the third is potential elimination of 100% of the gain on appreciation of your investment in the opportunity zone. And I'll go into a little bit more detail and show you an example or two about how that works. So as to the first point, the deferral of the gain that would otherwise be recognized or taxed currently, the gains from the sale or exchange of property can be deferred by investing in a Qualified Opportunity Fund. By property, we're also referring to intangible assets, stocks, artwork. It could be artwork, it can be a building, pretty much any type of gain. And the tax on those capital gains can be deferred until December 31st, 2026, or until the investor exits the Qualified Opportunity Fund, whichever's earlier. The second part of that is the potential elimination of up to 15% of that gain. So if you take that gain, you invest it in a qualified opportunity fund, and you hold your investment for at least 5 years, you can permanently eliminate 10% of that deferred gain. You hold it for 7 years, and now 15% of that gain has been eliminated. It's important to note that since December 31st, 2026 is the recognition date, only investors that get into an investment in an opportunity fund by December 31st, 2019 are going to be able to reach that 7-year requirement for the 15% reduction in the gain.
And Kathy, I think that's part of the reason why this market and this topic of conversation has been so active right now, so hot, is because people are reaching the end of that window.
The clock is ticking. So on your screens right now, you should have a graphic showing just an example of what a 2019 capital gain would look like if we went in the one direction. We recognize it and we pay the tax right now. We're going to be paying $476,000 if you're in the top tax bracket for capital gains. So you're going to be paying tax of $476,000 in 2019 on that capital gain. If I reinvest the gain in a qualified opportunity fund, the tax due in 2019 on that gain is $0. And then I hold it for 5 years. And now the amount of taxable capital gain has been reduced to $1.8 million. If I sell it at that point, my tax is now $428,000. But if I hold on to it for another 2 years until the end of 2026, my taxable capital gain is now $1.7 million instead of $2 million. And the tax on that is going to be a little over $400,000 as opposed to $476,000 out of pocket today.
And I think that's really a tremendous advantage to the investor. You're not only going to gain a reduction of your taxes of almost $70,000 after 7 years or almost $50,000 after 5 years, you get to hold on to your money for an extra 5 to 7 years. So our slide does not take into account any of the inflationary effects, but obviously the time value of money would tell you I'd much rather spend $70,000 less 7 years from now. The actual value of that is substantially less in real dollar terms today. And I think Kathy did mention, and we just want to reemphasize, that the capital gains rate that we're using is the maximum capital gains rate under law today.
That's right.
I do not know what the capital gains rate will be 7 years from now. I'm not a very good fortune teller.
Well, and if you're in a position where you would be in a much lower tax bracket 7 years from now, then your capital gains rate could be lower even under the current tax law. So, but it's super simple explanation without getting into the weeds. So the third benefit that I talked about is the potential elimination of 100% of the gain on the appreciation in the opportunity zone investment. So an investment in an qualified opportunity fund will receive 100% step up in basis to fair market value if it's held for at least 10 years. So that means that the growth on the qualified opportunity fund investment is excluded from taxation 100%. And that's kind of a big benefit.
It definitely is. And I think that one thing that is interesting about this benefit is that it extends far past most of the other sunset provisions in the Tax Cut and Jobs Act. Yeah,
so you don't have to sell your investment in the opportunity fund at 2026. And I think the designation for opportunity funds is extended currently out to 2047. The government doesn't want everybody taking their money out of these investments at the same time.
There are many things that we can schedule out to 2047.
Yeah. But this maybe you can.
A rare benefit.
So the example that I have on your screen about the elimination of the 100% gain on the appreciation is if we take $2 million today and I can invest it in any type of investment, the stock market, let's say, or I take that same $2 million and I put it into a qualified opportunity fund. Let's assume that in either case, we're going to get a 6% investment growth, which is now going to bring us to a value after 10 years of $3.58 million. So if I've invested in a stock and now I want to sell that stock, the tax on that growth is going to be 23.8% according to today's tax law, or $376,000. Or I could sell my investment in the qualified opportunity fund, and now I've still got a gain of $1.58 million, but none of it's taxable.
And I think it's really phenomenal when you consider the ability to layer these benefits on top of each other. You not only can defer your capital gains from a sale of appreciated property, but invest it in a vehicle like we talk about in this example and get that accumulation of additional earnings on a bigger investment because you didn't have to pay the taxes up front.
It's a unique program.
Now, there are certain issues associated with investments and opportunity funds that we really do have to get into. The first is obviously the capital gains deferral benefit is a key benefit. And in order to avail yourself of it, you have a relatively short window in which you can make that investment. You have a total of 180 days from the date that you complete the sale until the date when you are making the investment into the QAF. There are some certain exemptions where, based upon the facts and circumstances associated with the sale, you might have a slightly longer period of time. If it's an investment you're intending to make, I recommend you not try to avail yourself of any of those extensions and just do it within the 180 days, so there will be no question as to whether or not you qualify for that deferral. The next thing to talk about is how you would choose to deploy the funds within qualified opportunity funds. One of the things about this area of investing is that there are a large number of different QAFs being formed in a number of different structures. And generally, we could say there's three types. One type is sponsored by leading investment houses, by real estate developers that take the form essentially of essentially like a mutual fund, where they have a very large body of investors. They have a well-established large body of projects that they are funding, and you achieve a certain level of diversification within the product. The second is the opportunity to invest in limited partnership interests from a single sponsor. Now, these might be a more localized real estate developer trying to fund a single project and selling partnership interests in order to fund that project as it goes along. This allows you to very closely target the project that you're interested in working in, but not take on any of the administrative headaches that you'd have if you try to do the investing directly. And then the third choice is to just do it yourself. So there is a possibility to set up your own entity, to find and fund your own project, and have that entity qualify as a qualified opportunity fund. If you're interested in pursuing this route, you have to be aware that there will be significant administrative items for you to consider. There's a requirement for you to keep sufficient books and records to do your tax filings at the end of the year, and for you to designate that you have met all the requirements of a qualified opportunity fund. Other issues might be the need for legal and accounting assistance in terms of doing all of the required regulatory filings as you go along, and to maintain in compliance with the tax code. Absolutely.
As to what types of capital gains are eligible for deferral, any gain that's treated as a capital gain for federal income tax purposes is eligible for deferral by reinvesting in a qualified opportunity fund. So that would include long-term capital gains, short-term capital gains, unrecaptured Section 1250, 1231 gains. It's important to realize, though, that the character of that gain, is not going to change. So if it's a short-term capital gain today, and you reinvest in the qualified opportunity fund and you put off the taxation of that gain, it's still going to be a short-term capital gain on the other end when you cash out of your investment.
Your short-term gain 7 years later.
Right. So the tax rates that apply to short-term gains will still apply then. It doesn't make it a long-term gain because it's...
Right. I think one other thing that we really wanted to touch on here, and we really don't want to get too deep into the entrails of the Internal Revenue Code, but as part of that Tax Cut and Jobs Act, there were some changes made to Section 1031. Now, those of you who are familiar with Section 1031 might know that it allows you to sell an asset and purchase a replacement asset and account for it as if it was an exchange. That gives you certain benefits where you're not paying capital gains tax and you're able to deploy more of your funds into the new investment. The Tax Cut and Jobs Act eliminated the availability of deferring gains under Section 1031 for anything other than real property. One example that comes up often in the professional practice that Kathy and I have, we deal with a lot of restaurateurs. And oftentimes they will sell a certain restaurant, take those gains and defer them under Section 1031 to invest into a new restaurant. The ability to do that has been dramatically reduced. If that restaurant happens to own the underlying land and building, which is often not the case, but if they are, they're able to defer the portion of the sale proceeds related to the physical property, the real estate, and the building. But the amounts related to franchise agreements, other intangibles, furniture and fixtures, all of that has to be taxed at the time of sale. So they've lost the ability to use Section 1031, but they do have the ability to use a QOF, investing in a qualified opportunity zone in order to defer those gains.
That's right. And in terms of eligibility, anybody can defer gains using a qualified opportunity fund, right? I mean, there's really no.
I mean, I think the only people that are expressly forbidden are people that aren't paying taxes anyway. So if you're a non-for-profit or a church,
Right.
you don't have access to these types of investment vehicles, but they would not be attractive to you anyway because you're already not paying taxes.
Right. So any type of taxpayer that's not a tax-exempt organization. And the mechanics of deferring a capital gain are very much like you would report any capital gain. You would do it on the same tax form as we report recognized currently taxable gains. We would just choose an exception code that lets the government know that we're deferring this gain.
Yeah, so that would be on your Form 8949. It's a real page turner. I recommend everybody go home and read it. It's a great pleasure. So we wanted to just talk about some of the considerations you should make before investing in a particular QOF. As we mentioned before, there's only a very short window of opportunity to receive the maximum benefit under these rule changes. And because of that, these qualified opportunity funds have been organizing and going out to potential investors in a very, very rapid fashion. Because of that, some of them are not even able to give you a very complete picture as to what their long-term investments will look like. They're raising money, and based on the money they raise, then they find an investment to push the money into. So you really want to be certain when you're making an investment that the fund that you're investing in has discrete properties and discrete projects in which you want to be a party. And depending on the structure, if it's organized in a pass-through entity form like an LLC that's taxed as a partnership or in a partnership form, the locations where these projects exist could affect your personal taxes and force you to file in states where otherwise you would not have filed. So there is a large potential downside from certain funds depending on how they're organized.
Yeah, absolutely. And you want to think about who's running the fund and what the projected returns are. So I suspect, I mean, this is all new and there's all kinds of funds popping up all over the place, but I suspect that the better funds are going to be created and run by experienced real estate developers or people that are currently in projects in those spaces and in opportunity zones or developing. It's going to be a complicated venture for somebody who's brand new at this and trying to follow all the requirements and economic development circumstances
Sure.
that you're going to need to be aware of in the target areas.
That's definitely the case, and it's particularly the case if you're trying to set up your own fund. Now, there will be certain investors, well-qualified investors that have a long background investing in real estate management deals or in certain types of businesses. One of the things that we discussed offline earlier is that we have certain clients that have pre-existing facilities that are located in qualified opportunity zones. And they might want to set up their own private QOF in order to fund redevelopment of their properties, investments in substantially new equipment for manufacturing or for processing. And it really does give them an appreciable benefit.
Absolutely.
But again, as we mentioned before, you really have to be careful about the amount of overhead complexity that's associated with these types of investments. One of the things that people often don't think about is what do you do when your recently redeveloped apartment building starts taking tenants? Are you ready to start maintaining the rent rolls, or are you going to need to retain a property manager and give somebody else a substantial piece of the pie? So again, these are all the things that you need to think about when you're going into your own funds.
Yep, absolutely. And just as an aside, as a research tool, there's guides out there. You can find a listing of all the existing opportunity zones on the IRS website. There's some, I think we have available searchable links to opportunity zones, or it's not up.
Yeah, that tool will be coming up on our website very soon.
So there's also this Locus National Opportunity Zones Ranking Report, which ranks opportunity zones by smart growth potential and social equity and vulnerability, which is something, you might want to look into if you're considering investing some cash into something that you're not going to be running.
Yeah, and again, when you look at it, some of those leading municipalities are ones that are well known to us. So I think Newark was number 6 on smart growth potential.
It was
6 out of 9,000. That's not too bad.
Yep.
Way to go, Brick City.
Absolutely. some good potential there.
I think the one other thing we really wanted to talk about was the availability to avail yourselves of other tax benefits and other incentive programs while you're participating in these opportunity zones.
Yeah, so some funds will invest in projects within zones that are also in areas designated for state and local incentives, like pilots. Governor Murphy just made a proposal the other day for a new jobs-based incentive program for jobs that are created in ozone tracts. Also, the New Jersey Economic Development Authority is moving to the Gateway Center in Newark, which is in an opportunity zone. So there's ways to double up on benefits.
Right, and then those programs are both from the state level and from the local level throughout the Northeast and really throughout the country.
Yeah.
Particularly when you have projects that will increase employment. There's a lot of employment-based opportunities to get money from other financing sources.
Yep. So a few social considerations, I guess, if you're investing in an opportunity zone because of altruistic reasons, which is great, you might also want to consider that all opportunity zones are not created equal. So when you're doing your research, you might want to keep in mind that though the average poverty rate of the opportunity zones is about 29%, some states skipped over the truly needy towns in favor of areas that were already gentrifying, or in favor of towns that were college towns with large numbers of students, which artificially increased the poverty rate. The states are obviously looking out for their own best interests as well as the individual towns. So
I think the final thing we really wanted to touch on is that there's no guarantee that just through investing in an opportunity fund that's investing in a certain opportunity zone that you're actually going to make anything better in that opportunity zone. You really want to look at the underlying investment and see that it is complementary to the residents of that zone, to the skill sets of the people in that zone, that it will help build like a better or a firm economic foundation for them.
Sure.
And this is part and parcel of the investment decision process. You know, you don't want to invest in a hotel that will be built 2,000 miles away from the nearest large city or in the middle of nothing. Similarly, you don't want to invest in, or you might not want to invest in projects that will lead to displacements of local residents,
right,
or drive out local businesses in favor of big boxes.
And in some cases, we don't know what the effects are going to be, so it's just the best guesstimate at this point.
Yeah, that's
lots
definitely
to consider.
So as I'm sure you could tell, this is a fairly detailed area. If you have any questions related to the availability of QAF investments or how they would work for you, please feel free to reach out to us. I think our contact information should be on the screen. Again, thank you so much for your time. It was a pleasure spending this 20 minutes with you.
Thank you.